Good afternoon and welcome to this next episode of Governance Dialogues. It's my pleasure to welcome you back on the channel. My name is Elisa Cole and I'm the Managing Director of Governance Center. And as you know, this channel explores subjects related to governance and topical subjects. And one topic that I'd like to come back to in this episode is a theme we've explored in previous dialogues, is governance of banks. And I think governance of banks is something classical in the governance debates in the banking community. It's something like, Caravaggio paintings or Bernini sculptures. It's something that doesn't seem to go out of fashion because there is always a banking crisis because, if you look at regulations, whether it's Basel Committee or national regulators, they're always trying to address issues or lessons learned from the various crises. The latest, of course, debacles with, for example, Credit Suisse, which we would have previously thought would be kind of an untouchable bank. And I was actually in Saudi Arabia when that unraveled. So I'd like to come back to this topic. And I invited a fascinating speaker on this episode, Rajeev Kakar, who joins us, I think, today from Dubai, if I'm not mistaken. Rajeev, welcome to this episode.
Thank you, Ali.
And maybe before I introduce you, I'll just say kind of a few words around your background, because you have a fascinating history in the banking sector, both in executive and bank sort of board roles, and of course in other organizations as well, but in banks in particular, from Central Asia to Middle East, where we met a couple of months ago in Saudi Arabia, but also in Turkey, in Africa, and many regions. So I think that I couldn't think of a better person to actually invite to explore this issue of emerging markets and banks. And of course, emerging markets is a loose term because they're very different, and because some of the markets we would typically consider as developed would now you would question whether they're actually developed or emerging. So with those caveats, I'd like to come back to the issue of governance in banks. And you had a really fascinating history at Citibank, boards of a number of banks in Greece, in Saudi Arabia, Bahrain, and a couple of other countries. So I'm hoping you could share those with us today. And welcome to this episode.
Thank you, and thank you indeed, Alisa. It's a real pleasure to be here. I've been seeing your governance dialogues, and I'm really looking forward to this discussion. And just to add to the geography bit, I've also worked a lot in Asia, 15 odd years, and India, of course. And so Asia, Europe, India, and working for an American bank, and Africa. It's been a fascinating experience, and there's so much more to learn. And I continue to feel that one is a student forever. We learn every day. As you can see, the world is volatile and things are changing.
I'm sorry I forgot those couple of geographies that are obvious, but it's true. Rajeev, remind me come back to, I have a number of questions. I don't know if we'll manage to fit them all in half an hour that we have dedicated for this program, but just to, let's say, start from the basics. You've been part of a number of boards and on a number of committees, especially I know, and we'll come back to the point of your role, and particularly in risk committees, because that seems to be the place where banks always want you to be present. But if I can come back to this issue of nomination of boards, what are some of the lessons or kind of thoughts that you've been able to draw on your experience in terms of structure of boards that actually work? In different parameters, whether they're staggered boards, whether they're boards that have limitations to their mandates, or particular governance mechanisms that have been used to actually bring in the right skill set on the board, and to have also a cohesive board, because it's not just a question of people, but how these people sing and dance together, if I may say.
So I guess you've actually hit the nail on the head. When it comes to managing a board, and it's always a very difficult decision for any company for the management, certainly to accept a bunch of board members, and at the same time for the shareholders and the stakeholders to get the right bank board members. And we have to realize that there are often multiple stakeholders to a bank. It's not just the shareholders and not just the employees. It's not just the management, but there are customers, the depositors, the investors, there's bondholders, and of course the regulators and the media and the public, because we're dealing with money. And when you're dealing with people's money, everyone's interested. And when things go wrong, I guess the banker is wrong. So the task is a delicate one. The task is one of bridging between the stakeholder community and bridging between the management that is really managing the business on a day-to-day basis. So I guess the role of the nomination process is extremely important. You often hear of this term or this phrase, fit and proper. Now, what does fit and proper mean? It doesn't really just mean getting a regulatory confirmation that you can place someone on the board. And I think when you're dealing with money and you're dealing with an institution which inherently is taking risk. Banking is about taking risk. Banking is about risk and reward balance. Banking is about risk, reward, leverage. And banking is not about running away from risk. Banking is about taking predictable risk and profitable risk that you can measure. And when something of that is to be done, we also do have to realize that the quality of people you place on the board is extremely important. And there cannot be any situation where a single board member or a single set of board members are likely to know everything that could happen to a bank. A bank is something that is being subject to all kinds of risks, interest rate risks, reputation risks, credit risks, political risks, social risks, economic risks, or even pronouncements by leaders around the world. If something happens, it can overnight make a big difference. And remember, it's a leveraged position. It's often a leveraged entity. And the impact on the entity can be several times more magnified than the stimulus that causes it. So you have to be very careful. And so I guess one of the most important parts of the nomination is selecting the board members, identifying what fit and proper means. And fit and proper for an institution is often linked to the kind of business, the kind of market, the stage of the business, the stage of the challenge should mandate the kind of board members you have. And it is always good to have board members who have some level of technical expertise, business expertise, banking expertise, but also sometimes board members who have academic background, technical expertise, technology expertise, compliance expertise, or even those who can see trends because those inputs are important. And the next thing, I think the nomination process has to be able to see how they put the skill matrix together. Is there together, as you put together a team of 7, 10, 9, 11, whatever be the number of the boards, a good composition of independent board members, non-executive board members who are not independent, as well as executive board members. So it is, you often hear the term independent. And what does independent mean? Independent just cannot be satisfied if you place somebody on the board who doesn't own shares or doesn't come through the shareholder nominee. Independence really means you get in people who have the knowledge, who have the understanding, who have the experience and the ability to be able to make a difference, but they operate from an independence of mind and independence of opinion, with a fundamental duty of care and loyalty to the organization, which really means you actually take care of all stakeholders. And something which often causes conflict is when you have independent board members who end up towing the line of a majority shareholder or a majority investor, but don't realize that the fundamental responsibility often goes beyond that to the smallest investor or the smallest depositor. That's really the role of the independent. The non-executives, board members who are not independent, have to depend on others.
Let me come back to Rajeev. May I ask, just to delve into this one comment that you were making around duty to all. I mean, theoretically speaking, we all understand that. In practice, we know that it's also a challenge. So if we look at Middle East, as you know, we work with a range of companies and from state-owned to listed and whatnot. There is still this kind of mindset that let's say if I own 51%, and that's also a particular mindset of many investors who want to have control. That they control the board. So if, let's say the board is 11 people, if I own 51%, I want to have 6 members of these 11. And then the other shareholder who owns 20%, he wants to have his proportionate. And that kind of works also with complications, but let's say in other sectors. Now, in the banking sector, of course, if you go down that route, you actually risk, I think, in important ways, compromising this balance of skills that you spoke to. I mean, could you talk to us a little bit about, how that process works out in practice when there are real kind of, desire by majority shareholders to have their proportionate representation and making sure there is still the right collective skill set on the board?
So I think you raise a very important point. Theoretically, that is possible. And actually, in many situations, that does happen. But firstly, in general, across all jurisdictions, to the extent possible, banks are widely held. So you don't really allow any single investor to normally hold a significant shareholding. It is true in places, especially markets which are nascent or where there's development going on, a national development going on, or policy directives, there may be banks with a greater amount of shareholding that is held by the state or held by a particular family. Now, in such situations, Elisa, the regulator plays a very important role. And there is a strong division when it comes to banking between the role of the shareholder, the role of the board, and the role of the management. And increasingly, at least that's what I'm seeing in most jurisdictions, and Middle East is definitely on top of the list when it comes to institutionalizing the process and distancing shareholders from board management and the management. Because each of these things, while you can exercise control, remember it's a leveraged business, it's a regulated business, and most of these governments or quasi-government entities would obviously like to distance themselves from something going wrong because there are social, political, and other connotations that are involved. The other thing also is that there is a strong responsibility and understanding that this business is best managed by people who are experts. And, when I spent 15 years with Temasek, where we built a global banking group in Asia and much of the emerging markets around the world, I learned a very important lesson. That's really where I think I learned my skills at board management. As there, of course, we were nominee shareholders, or we were directly managing the entities that we were investing in, and we were operators. One principle I learned was, and this was a policy that came to us from Temasek, was, and I'm naming them, but it is a wonderful quality, that the shareholder should remain twice removed from the management. And mature twice removed. So even if you have a significant shareholding on a board of a bank, sophisticated, long-term, positively focused shareholders today and mature shareholders, and I would assume a bank would only have mature shareholders, otherwise they won't be allowed to run a bank, like to have professionals on board, give them a fair bit of, they may nominate them, but they're still expected to act independently, exercise the independence of mind, independence of opinion. And that's where they go through a lot of pain, selecting people who are in a position to stand apart from the shareholder and be able to tell them exactly what has happened. And the last thing I'd like to say is that the board member is actually an essential conduit between the management and the stakeholders. The shareholder often, in terms of hierarchy, comes last in the stakeholder list in terms of seniority. If you look at the hierarchy of importance, even though they have the maximum at stake when it comes to handling some of the social and other elements that are involved with banking, it is important that the person who takes a regulatory position on a bank, which is the board member, once chosen, actually ends up taking a strong fiduciary responsibility on a personal basis to be able to do what is right. So I think there are checks and balances. There are, of course, situations where board members may choose to be, choose to go along with groupthink or groupspeak, something which I think is fundamentally a disservice to the board on which you work, or sometimes just to be popular, they say yes to everything or rubber stamp decisions. But by and large, that is often not allowed, and mature board members do not do it. On the other side, as you said, you don't want overly conflicting or conflictive board members who conflict on every little matter, because then it doesn't ever become productive. So what is important is independence with a certain amount of ability to be able to exercise check and balance with the fundamental desire to do what is right for the organization and right for the stakeholders. And it involves a lot of trust building, a lot of mutual trust building with the management. So it takes two to tango, I have to say.
Indeed. Let me come back and pick on the topic that sort of the last words that you just said, sort of in terms of trust with the management, because it's a key thing. And there we've seen different scenarios when we work with banks, especially in the GCC. It's relatively common, and I think you would agree with me, but please, I look forward to hearing your perspective. On European boards, it's very common to have at least one executive, so not, i.e. the CEO on the board. Now, if you look at for example, Saudi banks or banks in the GCC more generally, or companies more generally, oftentimes executives are not on the board. So we worked with a number of banks where you do not have any executive presence on the board. They are invited, obviously, to attend the board meetings, but they're not part of the board. And what I wanted to get from you is your sense of these various practices, or in terms of the role of the executives, because it's also an issue on which, as you probably know, the ECB commented in its last review of the governance and risk principles, talking about the fact that, and I quote, they said, another root cause of ineffective management bodies is when executives are systematically present in meetings of control functions, and they observe that in sort of 55% of the banks. So where executives are participating in, let's say, risk committee discussions or whatnot. What is your sense of what the right balance is with executives? Should independents have their own forums to discuss things outside of the board? Do these mechanisms balance each other out somehow? What are some of the, let's say, practical solutions to this conundrum?
So I've seen the entire range of what you mentioned, and I'm familiar with what the ECB wants. I do agree with the fact that boards should be of a size that is still wieldy. There are sometimes I've seen boards just to accommodate executives tend to be as large as 13 or 15 people. So that becomes very, very unwieldy. So then there are boards who just don't have executives. So I've in my view, and I think increasingly regulators are moving towards it, I think at a minimum having one or two executives on the board, typically the CEO for sure, and maybe another person who's handling a responsible task. Could be the CFO, it could be a lead business manager, etc. It does help to have one or max two executives. I've seen a board in Europe where we had as many as 4, and that was crowding out the process. And just to keep the balance, we just had a very large board. I also do subscribe to the fact that when it comes to control board functions, especially compliance, audit, internal audit, risk, and some of the other elements which do need an independent assurance, there should be a very clear understanding that the membership has to be of independent non-executive directors, and the executive directors or the executives can only be invited in where required for specific matters, but do not end up being there all the time. And it is a fact that when you're looking at audit heads, compliance heads, or risk heads, they report directly actually to the respective committees. They have a dotted line relationship. And yet the intent is not to keep the CEO and the management away to second guess them. Now, the moment you do that, you break trust. Remember, I did talk about trust. If you believe that someone is not trustworthy, then I think the problem is far bigger than just keeping them away from the committee, and something needs to be addressed by the nomination committee and the board. But if there is trust and you know that you have the right people on the job, independence is only there to make sure that the people who are responsible for the specific function are given a forum to speak independently and share whether they have adequate tools, adequate processes, adequate capacity, the right expense, and the right culture, and they're not being bullied or forced to do certain things. So, and I talk about mutual trust, and you're talking about board composition and design. I do think a couple of executives, certainly the MD should be there, because remember, there are 3 different, the role of an MD is very different from the role of the CEO. And it's often important that the one who executes in an executive capacity should also have a role to see how the decision making is done. And this role acts as a very, very nice bridge between the two. And I think most regulators are now almost mandating that be the case. There are institutions which also keep the chairman, managing director, and CEO in the same person. That, I think, is not okay. And
I would agree.
yes. So the chairman's role and the MD CEO's role, the MD CEO role can be a common role, and the chairman's role needs to be separate, because the chairman provides the independence versus the board, and also helps coordinate the committees. And the committees, of course, which are regulatory or control oriented, must be independent and must have an independent composition with the right technical expertise, and also the right gravitas, the right experiences, and a certain amount of diversity in terms of what they've done. I've seen some committees where people are sitting on boards just because they worked in a technology company. Not all technology people are great at using technology in a bank. Just because you work in company XYZ, or you've just launched the latest generative AI, does that make you a right to be a technology person in the bank? Because technology firms work very differently than banks do. You're handling very different objectives, but it helps. So it also always depends upon the kind of person you're talking about. How you could be a technical expert, but are you a conceptual expert? Are you able to use your technical skills and interpersonal skills in a sector that's agnostic to what you have been doing in your real life?
Interesting. This IT comment is very interesting, because there's so much debate about bringing IT expertise on bank boards. So this, I think, is very on point. But since we're talking about executives and their role in the board, one practice that I've seen at some of our clients is that, again, if we look at Saudi Arabia, I mean, a number of the committees have independent, so separate board secretaries. So normally, I mean, a European bank would have a board secretary that does the board, the audit committee, the risk committee, etc. Now, if you look at some markets, again, as I mentioned, Saudi Arabia, you would have, for example, CHRO as the secretary of the GNRC. You would have head of internal audit, often as the secretary of the audit committee, and risk, and so on and so forth. I personally have, frankly speaking, mixed views about this practice, because I think it's very context dependent. Of course, trust, as you say, is a key parameter, but I think there is in my view, if I may say, there is a conflict. Would you agree with that, or do you think that is a practice that actually, in practice, for technical reasons, regulatory reasons, is something that works well?
So you're absolutely right. In Europe, for instance, or even in Singapore, for instance, and in many mature organizations, you have a central secretariat function. And the secretariat function has a team of 3 or 4 or 5 people who are specialists, who have a legal background, who understand, in countries like India and Britain, to be a company secretary is actually a profession. It's something that you go through certification for. In several other markets, I see a different model, which you've rightly mentioned. The secretariat only attends to the board functions, but the individual functional experts or the heads act as secretaries, and that's true of many jurisdictions. You've named one, but it's not uncommon. It happens a lot, and very often I think it happens not because that's the best model. It just happens because of it could be given the size of the bank and the expertise involved, and what all you need to do, and to be able to make things work and get the right amount of people and manage cost. People tend to double hat. If you ask me what the pristine model is, I think the pristine model is the way you described it, is to have a central secretariat, people who are there and they understand what being a company secretary involves. They have an understanding of legality, they have an understanding of regulations, they have an understanding of the function. It is their job to maintain a common standard of minutes. Now, the ECB, for instance, as you know, and most regulators do want to see debate and challenge in the minutes. They do want to be able to understand that what is being recorded is indeed what was discussed in the meetings. And short of regulators sitting in some countries that has happened in Europe, which I'm totally against. I'm totally against regulators sitting in, because then you don't need board of directors. But it's extremely important to have an independent secretariat function. And a good secretariat actually makes the board effectiveness several times bigger and better. And I've said this to secretariats because you also must rate it. When you look at board effectiveness, it's important to look at the effectiveness of the secretariat. So if you really ask me, I think the best model is to have a central secretariat, because it leads to standardization. It leads to a common set of minutes being recorded. It ensures that processes are handled. It ensures that how the information flow in the board and the board committee is run with a certain level of formality. They're very cognizant of what needs to be covered, and they're also extremely cognizant of what needs to be referred, because sometimes you may need to refer a matter between 2 committees before it heads to the board. So I think it makes sense. But having said that, if the bank is not such a big bank, it's not such a complex bank, then even the other model works until the bank reaches a certain amount of size and shape and then achieves a common sense. So that should be the end state. That's the ideal requirement, but sometimes depending on the size and the complexities of the talent available and the resources, I guess the shorter cut is taken.
Yes. And ironically, I think just bouncing back, actually some of the comments we've heard in defense of this model, because you mentioned in your remarks, as you were talking about the regulator auditing board meetings, and I'll come back to central bank supervision audit issues in a second. But I think there is a fair level of, let's say, concern or kind of tremor in the boardrooms that the board meetings might be audited, and that these need to reflect certain regulatory parameters. And actually, it's interesting because this issue of let's say CHRO being the head of GNRC and sort of having separate board secretaries, actually the reason that was given to me by some banks is exactly that if we have the central bank review our notes and we don't have a specialist in this particular issue being the secretary of the committee, then maybe the board, the committee meeting minutes might not be drafted in the way that addresses the regulatory concerns. So it's all
But that is often handled very well, because remember, even if you have a common secretariat like we see in Europe, it is the secretariat works with the specific group head or the functional head and make sure that what is being recorded is recorded correctly in a technical sense. But on the other side, they have to make sure that they minute what is truly discussed, and they have a way of doing so. And the third element, because I every year I have an annual meeting with the ECB on one of the board positions I have in Europe, and we are interviewed by about, I just sit through a 4-hour session with 4 or 5 people from the SSM on the other side, and you're questioned on all kinds of things, and you're handling it without management. At that point of time, one of the things that they really do look at is the quality of your minutes. And they like even minute taking itself is an art. Some boards actually just write about the final decision taking. Some boards actually sit back and just replicate what was on the presentation. But regulators increasingly want to see what was said by different people. They want to see whether a matter was discussed, whether a matter was debated, what was the thought process that went into making sure that you could reach a particular decision. They want to see the journey. And then they also sit back and evaluate the effectiveness of how that decision has been made. So it's not a CYA action. It's not an action just to cover your backside, but it's actually an action to document the thought process, to evaluate what the board does, and also for posterity, to put a reason behind it. Because I have seen as an executive myself that every time a new executive comes into a role, the first thing you do is run down the past. Now, I'm sure every sensible executive takes good decisions. Every board takes good decisions, but situations change, and a decision in the past may not work in the new circumstance. We're seeing that today in the world, where so many political inclinations are suddenly changing with a single announcement, and things are going to change. People have invested, people have walked out of investments, trade flows have changed, and suddenly things can change. So you can't blame the management at that point of time in the past who looked at a particular situation with a set of inputs to be responsible for something that went completely haywire. So I think taking good minutes is extremely important. Making sure that you record, since this is a fiduciary role, making sure that objections and discussions and the strength of the rationale is documented well, and making sure there's a consistency in the approach really works well. Because once you do that, then it actually helps defend the management. It helps assure the stakeholders that there was a well thought out process and there was no randomness to it. And actually, if you're collegiate enough and mature enough in a board, nobody minds, recording debates and challenges. Remember, debate is not conflict. Debate doesn't mean you disrespect someone. Debate actually means you're engaging with someone. You care for the business. You're caring to respond to the business. You're giving a suggestion based on your genuine experiences. And after that, you converge and reach a decision. And it is often said that when people come together, the process may be tough, but more than one person making a decision often leads to a better quality decision and a better buy-in.
Let me come back, Rajeev, just one point that you're mentioning in terms of kind of debate and in particular, this government intervention and whatnot. I think it's particularly maybe relevant or of higher sensitivity in the context of government bailouts or major restructurings. And I know you've been part of these types of conversations also in the past. Could you just, maybe say a few words about the challenges you faced or the challenges you've seen, maybe not personally faced, but the challenges you've seen from a board perspective when you are, where every word actually counts, because, there is not just a business as a usual situation where the regulator might come in and ask to see the board meeting minutes of committee X or Y, but where they are, that they will be looking at these meetings and, because European funds have been injected or whatever the situation may be where their crisis mode kicks in. Are there differences in how board discussions actually transpire in this context, since you've seen them from the
I've seen them very much, and I've seen them both as an executive and also sitting on a board on the boards of banks. And I can say one thing that a banker signs up for is crisis, because that's one thing that keeps coming back. You said it in the preamble, and I think there's always some crisis the other. Some crises are really existential. And I guess your references to, situations of a bailout or situations where there can be a major default in a country, etc. I've been through it. I was also I was in one country and two countries neighboring each other, which have been through it at different points of time, and I've worked in both the countries. I have to say, it's probably one of the most engaging, most trying, and often a very difficult task. It also involves a lot more work, a lot more experience, a lot more patience, and a greater degree of involvement. I think in such a role, of course, you're managing multiple stakeholder tensions. It's not a happy position for the management to be in it. The public hates you because if things go wrong, then I guess bankers are blamed. But banks are essential for the government. Governments are driven by their national priorities, and I guess regulators have their own requirements to keep risk under control, to be able to make sure that there's capital and keep the banking system afloat. Remember, if the banking system in a country fails, then very often the country itself will go through a much bigger crisis. So it is a very difficult balance. And then, of course, media and public groups, common interest groups will love to take pot shots against banks because, and we've been through that in the 2008 crises. We've been through that in the European crisis in many parts of the world. And we've also seen idiosyncratic crises with certain banks in different parts of the world. And you did mention Credit Suisse, the Silicon Valley Bank, etc. So, but when you deal with macro stress of this nature, you're bound to get regulators and media all over you. And my experience really is that this requires a lot of stakeholder tension management by the board members, certainly by the management too. Sorry, yes, you were.
No, I just wanted to come in on one particular point of managing stakeholders and all these tensions, and that is your role in risk committees, because I'm assuming, but do tell us if you feel that the people around the table at the risk committee have kind of higher brunt of, let's say, responsibility or sort of a lot of responsibility in these types of situations. And previously you mentioned also in your comments interactions between committees, because I think that's something also kind of not neglected, but not very much explored. So how does risk committee in these types of situations interact with audit committee? What are some of the kind of pressures that these committees might be dealing with in these turnaround or restructuring type situations? Is it fair to assume that the risk committee takes a heavier hit?
I think when it comes to matters of this nature, it's not just the risk committee, it's the risk and the audit committee that take a greater amount of hit, and to some extent, the governance and the nomination committee. I think that would come third. But the risk and audit committee are two committees that take a larger share and a larger brunt of this process. So, for instance, in this bank I'm in, where I chair the risk committee in Europe, which has come out of a particular tough situation, and you know that the European regulators are pretty strong. They mandated that there are firstly international shareholders who are part of the board as part of the nomination, but there is also a very strong schedule. At a minimum, we meet once a month. There are times we meet twice a month. So you're talking about 18 to 19 risk committee meetings in a year. And each meeting typically can go from anywhere between 5 to 7 hours. And which really means there's a lot to read, there's a lot to understand, and very often there's also between meetings a lot of engagement with each of the the respective management, etc. Because you don't want to go into these meetings unprepared and without understanding it. There are also, it's normally membership between audit and risk is not encouraged, but when pressures come up and when crisis situation comes up, I have noticed that regulators will insist that the risk committee chair and the audit committee chair, at least the risk committee chair, is also a member of the audit committee. And so, for instance, that really puts a lot of load on the board members, because you're suddenly a part of two heavily intensive regulatory committees. But that is required. This is almost like saying someone's going through a life-threatening situation, because you're dealing with resolution risk, recovery risk, you're dealing with restructuring, you're dealing with stakeholder money, you're dealing with bondholders' money, you're dealing with depositors' money, you're dealing with the national press, the public media, perception of the country. And you can only sign on to these board positions because you want to do that, and you're committed to making the bank succeed. And I have to say, during this process, typically what also happens is remunerations tend to get capped for management. as you have seen in Europe.
And for board sometimes.
And for board members, yes. But I think more important than board members, I think what is critical is that management tends to work extremely hard during this period. They take the brunt of most of the pressures, and they're also not being fairly compensated for it. And that itself, board members, I guess my view is board members should be fairly compensated, but board members should not sign on to this role just for the money. I guess board members sign on to doing this because they want to pass back their expertise. But management that really works full time, and oftentimes, as we've seen in some crises, the recovery takes as long as 6 to 10 years. That's a huge price to pay for anyone in that tenor who's got a professional career. So I do feel the involvement is far better, far more intensive. But I have to say, those are some of the best learning experiences you can go through. And I actually have learned so much more in these crisis situations. And when we were in Asia and we set up the group that I was responsible as a co-founder for, which is Fullerton out of Singapore and various emerging markets, I learned a Chinese phrase from the Singaporeans. And they often say that with crisis comes opportunity. And I can only say with every crisis, it's important to have good board members who can not just mitigate the risks that they see, but also be able to identify the opportunities that comes from every crisis. And a crisis is like a redistribution of resources, no different than an earthquake. Land gets redone. There are certain people who suffer. But guess what? You get more hills, you get more valleys. What was a valley earlier becomes a hill, but the world just becomes a better place. There are, of course, some unfortunate costs that go into it, but with each crisis comes new opportunities. And you need board members to understand that there's a phase of minimizing value destruction, and then there's a phase of maximizing value creation. And that's the essential J curve you go through. And that journey as a board member or as an executive is priceless, Elisa. The amount you can learn there is just amazing.
Now, it's very interesting to hear from you also some of the kind of more precise details from perspective of inside the boardrooms that we would not normally hear about in these crisis situations. And just in the interest of time, I mean, I could ask a million more questions, but just in the interest of time, if I may just ask a very quick last bite-sized question around bank failures that we've seen and international standards. So we know ECB just recently revised some of its governance standards. The Basel corporate governance standards have been the same for, frankly, quite some time. The OECD standards have changed in the meantime. Do you feel that, let's say, the international banking standards are currently reflecting, let's say, the state of learning, or are there lessons learned that should be still integrated today?
I think it's unfair to expect that any governance framework or any regulation will ever be ahead of any risk or any crisis in the world. Because if they could be ahead, we won't have those risks, we won't have those crises. And it is a fact that, so if you want my outright answer, the frameworks are very good. As of today, the frameworks are extremely good. But unfortunately, they will always be behind the level of risk that exists, because that's the nature of a regulator. It tends to be reactive in its actions. Because still, if you try to put regulation in very fast ahead of a crisis or a situation having happened, you will find management push back and banks and shareholders pushing back. However, I think that's where the role of a good board and a good, well-composed board comes in, because governance is a level above regulation. Regulation defines the minimum standards that is the common denominator for all banks. But the fact is that all banks are not similar. So while the common denominator takes care of the common regulatory risks that are seen in the system, I think it's the governance layer that good board members come in and provide based on their own understanding on a forward-looking basis, who constantly look at the social, economic, financial, geopolitical issues that are going on in the world, and exercise caution and continuously sit back and use governance frameworks and also stress tests, scenario analysis, and work it back and look at historical stresses and see what impact it could have to the capital of the bank. Remember, the board and even the committees, but even the board collectively has a responsibility of providing risk-adjusted returns, making sure that the bank is profitable. Risk is taken, but risk that is taken is measurable, it's predictable, it's priceable, and it's sustainable. And it's sustainable enough so that you can absorb issues or risks when the risk happens. But all this at the same time, in good times, it should be in a position to invest for the future. You have to change the bank. You have to walk, chew gum, blow bubbles, and burst them all the time. So it does require a very dynamic process. And I think to just depend on regulations is not enough. I think the regulations do get better after every situation happens. They learn from it. Like in the recent in the recent category of risks that we saw in Credit Suisse or Silicon Valley, interest rate risk, digital risk, concentration risks, depositor profile risks, and of course, reputation risk, or in the broader category of what we call non-financial risk is coming in. And I think that's what you call the pillar two credit capital requirements that are coming in. And smart board members actually even look at strategic risks, look at what could happen due to non-execution of risk. There's data risk, there's cybersecurity risk, there's physical security, there's political alliance risk. And some of these can be quantified. These are gray rhinos waiting to happen. These are not black swans that may or may not happen. But gray rhinos, as Michelle Wucker mentions in her book, I'm a great fan of that book, that these are expected to happen. They will happen. The pandemic was known to happen. We didn't know if it wasn't, the issue wasn't that it would happen. The issue was when would it happen? And hence you need to be able to see risks that are expected. We should be able to simulate them and work them to a high level of confidence and make sure that we are adequately capacitized. Thereafter, identify material risks, assess them, create the right risk appetite, build frameworks for testing them on a constant basis, look at capital and liquidity adequacy, look at interest rates. Today, interest rates have gone up and they will come down at some stage. What could be the level of sensitivity? That's what Silicon Valley faced on its market risk book. So I think having board members who can look ahead, who can use their experiences and leverage and look at the idiosyncratic balance sheet and the portfolio they look at, see the areas where management could be blindsided, where boards could be blindsided. When things are very good, to be a little prudent and understand what could go wrong. It doesn't mean you put the brakes on. It just means that you serve as the brakes that give you the courage and the comfort to be able to drive fast or fly fast. If you didn't have brakes, you wouldn't have the courage to drive your car. So I think it's an attitude issue. It's an engagement issue. It's the quality of people you have issue. And of course, I think the personality of the board member matters, and the culture and the dynamic of a board really matters. If a board can engage well, build mutual trust, and if the management can offer transparency, and the board member, I think a lot depends also on the board members to come forward and offer trust, offer transparency, not doubt people, but work with them and support and facilitate without conflicting themselves or without creating a conflict of interest, where you can still provide the check and balance, but the intent should be to help management and to work with them. So things break down when there is no trust. There are times when board members don't talk to each other, or there are times when they bounce on each other, or they are highly. There are all kinds of boards, but the most effective boards are those where you respect the expertise of each and every member, and each of them are eclectic. Each of them come with diverse experiences, come with diverse backgrounds, and there are political issues, there are national issues, there are social issues, not just technical issues. But collectively, you can conceptualize what could happen and protect yourself against it, and keep adequate buffers because you keep room for error. And boards that communicate well eat together, socially meet once in a while, make sure that they engage with each other and develop a healthy mutual respect. And I've seen that in boards. You've seen some boards where this happens. I think they tend to be the best boards. And such institutions always thrive. And problems will occur. But the asset test is not to have a problem, is not to avoid a problem. Asset test is to be able to absorb the problem if it happens. And in good times to be able to invest and be able to return suitable capital back to the investors and become a prime example and grow talent. I think talent is critical. It's this statement I have to make. If there's one capital element which we need to always remember in banking, whatever technologies come in, whatever happens with generative AI, banking is one business where the people difference will matter always because the decisions do matter. And that is why if I had my way with accounting principles, I would ask for them not to expense human capital expenses, but to capitalize them. Because I think that is
that would be subject to another conversation of this governance dialogues. But
Yes.
Rajeev, thank you so much for joining us, and it's been like a sort of, even for me, a fascinating crash course on the insides of the boardrooms, and we've crossed each other in some of these contexts. But I think it's also interesting to hear from crisis situations on issues that we talked about in terms of collaboration between boards. Some of the issues that you mentioned that are more kind of technical issues that maybe are not widely discussed, but actually are the reason we have this program, is to talk about these mechanisms that are perhaps.
And technical is as important as some of the interpersonal and other software elements, but technical itself is not adequate. At the same time, not being adequately prepared and not understanding the technical elements is also dangerous. So you can only provide for this by having a nice, delicate, diverse mix where each person complements the other person's shortfalls. So it really works well.
Thank you. No, thank you, Rajeev. It's been a fascinating conversation. I hope our listeners have also felt this way, and I'm sure we'll have other opportunities to delve into more specific issues. Perhaps we'll talk about risk committees next time, and just have a little bit more time to dedicate to specific topics. But for the purposes of today, thank you so much for joining us. And for our audience, please stay tuned to a future episode of Governance Dialogues. We'll continue exploring themes that are emerging in this field, and look forward to having you on this channel.
Thank you again, Alicia. It's been a pleasure.